Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the financial advice. This is not financial advice, but with everything going on in today's markets, I figured it's a pretty good video to make because a couple years ago, investing and making money was just as easy as plucking a coin out of thin air. Anyone could do it. But this year, I feel like investing is as risky as going to the casino because nothing's guaranteed. So here are the 5 simple rules that will hopefully help you out. But just like Captain Barbosa once said, think of these more like guidelines than actual rules though. Now, rule number 1 of investing is don't actually start investing until you're ready. Just like playing a game, you first have to equip your character with the best stuff to maximize the grind. I'm talking about double EXP, triple AP, all that in a bag of chips before you start investing. Now, the traditional rule of thumb is to start as early as possible, and that's true. As soon as you turn 18, get yourself a Roth IRA account and start investing inside of that account and try to aim for $6,000 a year. Because if you can do $500 a month, starting at age 18, you can become a millionaire by age 52, which is really impressive. Of course, by then, that $1 million will not be worth as much as it does today, thanks to inflation. But the more important thing people don't tell you is that no one really cares about old people and their millions. The only time wealth and money has ever mattered is if it's someone young or really good looking. Kind of like Justin Bieber. He reached a millionaire status by 14, and that's really impressive, and the world cares. But when was the last time you were like, Bill Gates has how many billions by 67? That's impressive. Said no one ever. Old people just want their rent paid, and they don't care about your Bored Ape Yacht Club NFT and your Lamborghini. So just treat money as a way to get freedom rather than a status. Now, chances are you're not going to be able to put away $500 a month when you're 18 because you're level 18 and you don't have a lot of money anyway. And whatever money you do have saved will go a lot farther when you invest that money in yourself rather than in the market. So a really good example is to spend that money to learn a skill or to get a career that pays really well. Right now, that means having a job in the medical industry or somewhere in the tech space. But whatever you do, don't get a job being a magician and disappoint your parents. Just kidding. You can make a lot of money as a magician actually, but if you're really good, which unfortunately excludes me. Rule number 2 of investing is to get a game plan together and figure out where your money is going to make you the most money. And for most people, that will mean to pay off their high interest rate loans. A recent Go Banking survey actually found that about 30% of Americans owe credit card debt between $1,000 to $5,000. They even did a state-by-state breakdown and they found out that Alaska was actually the worst state. So get it together, Alaska. Now, the average interest rate on a credit card right now is over 20%. That's pretty high, but here's a dumb question. If you don't have credit card debt, how else would you know if your loans carry a high interest rate? You would compare it to the opportunity cost of investing into something like the stock market, where you can expect to get anywhere between 8 to 10% per year on average. So even the stock market can't outdo the credit card market. So if your loans are higher than 8 to 10% or anywhere near that, then please pay off the loans first. Unfortunately, credit card companies have figured out that it was way better for them to invest their money into us rather than into the stock market. So never carry a balance, pay off the loans in full, and never let a magician borrow your credit cards because they'll never give them back. The third rule of investing is to know the basics. And one of the basics of investing is to set your expectation. And this is one of my favorites, and here's why. If I show you this ordinary playing card right here, and if I could just make it float for a second, that looks pretty impressive. And you probably pressed the J button on your keyboard to go back 10 seconds. And then you were like, oh, I know how he does it. But you can't do that in real life, so it doesn't really count. But the point is, if you saw David Blaine do that trick, you'd probably be pretty disappointed. The point I'm trying to make is that investing is not about becoming rich. Investing is about getting freedom. And the earlier you can start investing and the more seriously you can take it, then the earlier you can get that freedom. So setting your expectations is a big part of investing because good investing is actually really easy. All it is time plus money. That's it. Another important part of this rule to remember is that you can't beat the market, so don't try. But what about the buffets, right? The Buffett tells everyone, don't buy individual stocks. And then he buys individual stocks. But that's also Warren Buffett, and he's been doing it his whole life, and he was one of the first to do it back when the stock market was a lot less complicated than it is today. Unless you want to dedicate your entire life to valuing stocks, it's probably not a good idea to try to beat the market. But the question you might have is, what is the market? When people say the market, they mean this stock right here, VOO. Now V stands for Roman numeral number 5, and then 0000 is 500. Now this is what's called an ETF stock. Now WTF's an ETF. An ETF is an exchange-traded fund, and why it's called that, because by owning this one stock, you are then owning a basket of stocks, which in this case are the top 500 companies in the US. This is the market. Now sometimes the market is also considered this stock right here, VTI. This basket of stocks is also an ETF, and it represents the whole US stock market, thousands of stocks. Now the difference between VTI and VOO in the long term is very, very small. So they're both considered the market. Now professionals will pay an insane amount of money to try to learn and try to beat this market, aka these stocks. But you might have heard that over 90% of professionals can't. And that's true, but I also kind of have a problem with this statistic because it implies, well, 90% can't do it, but 10% can, and maybe I'm one of the 10 special few that can do it, but this is folly. No one can beat the market consistently. You might be able to do it once, maybe twice, maybe 5 times in a row, but no one has been able to beat the market over a 30 to 40 year career period. It's been tried and no one has been able to do it. Now what's interesting is that part of this rule, there's also the answer to the question, what's the best thing to invest my money into? For stocks, we know it's maybe VOO or VTI or VT or some variation of it. But what about in general? Is it real estate? Is it stonks? Is it bitcoins? Check out this chart. Over the last 200 years, it shows that the stock market has outpaced everything else. But why is it then that people say real estate is the best wealth building tool in the world for the middle class? They say that because for every $1 you invest in real estate, you can borrow 5 against it. This is called leverage. It's risky, but it can be extremely powerful if it's used right. Now, you don't have to decide between real estate or crypto or anything else. You can own all of that stuff, but what's interesting about the stock market is that even though it's supposed to return between 8 to 10% per year on average, research shows that the average investor only gets about 2% per year. And that's because everyone tries to time the market. They try to buy low, sell high, and that's because they think they're part of that special 10% that can sometimes beat the market. Unfortunately, we're not special. And by we, I mostly mean me. And rule number 4 of investing is to diversify and then pray for dear life. No, I'm kidding, but within the world of investing, there's 2 ways to diversify. You can diversify within an asset class and you can diversify among. So here's what I mean. Within an asset class like the stock market, by owning just one stock like VOO or VTI or VT, you can diversify and own several hundred, if not several thousand stocks by owning that just one stock. You're fully diversified. You don't really need to own any more stocks. But among asset classes means maybe you want to own some stocks and some bonds and some real estate. Whatever it is you're comfortable with, there's no hard rule when it comes to diversifying among asset classes. But when it comes to stocks, there is a loose rule that says as you get older, you should rebalance your portfolio. A fancy way of saying you should sell some of your stocks and convert them to bonds. When people say bonds, they're referring to BND, this bond right here, which is the ETF version of VBTLX, Vanguard's Total Bond Market Index Fund. I could be wrong, double check my work, but I'm pretty sure they're referring to this one. Now, studies show that owning bonds in your portfolio increases what's called your risk-adjusted returns, but lowers your overall expected returns. This is a fancy way of saying that bonds will hold you and hug you and caress you and tell you everything's okay by smoothing out the ride, but you will make less money having bonds in your portfolio than going 100% into stocks. Now, if you're someone who's afraid of volatility and you don't like the whole roller coaster ride of owning stocks, then owning some bonds could be super helpful. Personally, I don't really own any bonds because I think I can handle volatility, but I could be totally wrong. Maybe tomorrow I wake up and I see I'm down 99% and I'll be like, sell everything. Hopefully I won't though. But if you like bonds, there's a loose general rule of thumb that says you can take 110 and subtract your age to figure it out. So for example, if I'm 30, I would take 110 minus 30 to get 80, so 80% stocks and 20% bonds. There's other variations of this rule. Some people like to wait until they're in retirement to sell their stocks and convert them to bonds. There's no right or wrong answer. It's just whatever you're comfortable with. Rule number 5 of investing is probably one of my favorites, and I wish every investor knew about this rule. And what it is that there will always be a good sounding reason to quit playing the game. And in the case of video games, sometimes that is a good idea. You should quit and then go live life and maybe take a shower from time to time, and this is especially true for Yu-Gi-Oh players. But when it comes to investing, it is generally never a good idea to stop investing. Check out this chart. It shows that the stock market keeps going up despite major global conflicts, major recessions, interest rates going up, currency crises, and what's not pictured here are YouTubers telling you that you should sell because sometimes they can sound convincing. Another thing that can be a convincing distraction is politics. But research shows that regardless of who's in power, whether it's Republicans or Democrats, the market still continues to go up. So just remember all that, because the next time you hear, this time it's gonna be different, that will scare you. I know it scared me when the 2020 pandemic happened and everyone was saying that this time it's different and that the world was changing. It's scary times, but again, research shows that the stock market keeps going up. So just remember that if you want to get those juicy 8 to 10% per year returns, because you have to be prepared. Some years, the stock market will be down 30, 40, 50, even as much as 80% in some years. But that's how it works, because in the long term, when you average it all out, that's how you win. And rule number 6, and I know this is a bonus one, but the longer you stay invested in the markets, the higher the odds of you making money will be. So for example, if you stay invested in the markets consistently for 15 years, the odds of you having more money than when you started goes up to 99.8%. In fact, it goes all the way up to 100% in a 20-year rolling period. So investing can be a 100% guarantee as long as you have enough time to see it through. Now, unfortunately, that does not mean that your money is going to triple, quadruple, or 10x in that 20 years. It just means you'll have more than when you started. And that also means you can make $1 more and that would qualify, but hopefully it means you'll make a lot more. In fact, it could be 10 long years before you see $1 in profit after inflation. So just remember that going in, and the earlier you can start, the faster you can get to that 20-year period. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already, grab your free stuff, links are all down below, and then go track your free stocks automatically with the spreadsheet linked down below in my Patreon. Love you, thank you so much for watching this video. I'll see you back here on Monday, Friday, sometimes Wednesday. See you soon, bye-bye.